You're listening to The Move with Daddis and Michael Ray. Conversations exploring why healthcare real estate is moving from alternative to essential, and how smart capital is making the shift to one of the most overlooked asset classes today.
Hey, Mike.
Hola, mi amigo. Jared, how are you?
I'm doing fantastic. You work out today?
I mean, is it a day that ends in Y?
Beautiful. Let's dive into the topic today. So on a past episode, we talked about a barbell strategy. I want to do a deeper dive into that.
Okay.
I think it's in the context of what are we seeing in the marketplace from a high net worth investor to an institutional investor, but maybe a little more focus on the high net worth investors. I think some of the data that we've seen, typical allocation in real estate for a family office has been between 14 to 18%.
Mm-hmm.
But if I'm sitting here as a family office CIO or CEO, and I'm looking to deploy $10, $20 million into an allocation of real estate, in the context that my allocation could have been in the core asset classes of the past. And I've heard us talk about how some of those investments are there today. They may be more risky, and I don't know how to construct a portfolio. Where do I start? Where do I go? Because as a developer investor, I think we have a little bit of a different mindset of where to focus. But from an investor perspective, where do I start?
Yeah, I think you start, what's the old line? You start at the beginning and end at the end.
Okay.
But I think it's critical to have a level set. And so let's understand kind of where we're starting.
Okay. I just got crushed in office.
Yeah.
I've had some wins in multifamily, but I've had some losses because of interest rate fluctuation on how the capitalization was structured. Tasted retail a little bit. I'm long in land. Okay. And maybe I played and dabbled in hospitality and I got bit a little bit through COVID. So where do I go? What's my move?
Yeah. Your first move is to assess and understand, because you've had challenges clearly, right? Because, the report you're talking about is one that we sort of monitor, to make sure that we have our fingers on the pulse of sort of what's happening in the sort of family office space.
Right.
So this is a Knight Frank report. So it's fairly reliable. It's a global survey. So we believe that it's representative of an overwhelming number of family offices and their characteristics. So even within that sort of 14 to 18% of overall allocation to the real estate space,
right?
Within that allocation, it was overwhelmingly allocated within the real estate sort of universe to the very asset classes you're talking about. So office, retail, hospitality, and then some form of residence, right? Whether it's traditional multi, single family, usually single family for rent, and then maybe some students and seniors and things like that. So first thing to do, to your point, is to assess like how brutal were those wounds and challenges. What's my liquidity position, right? Because that's going to inform how you look at it going forward. But essentially you're looking at it and saying, so I love it when you make the comment like those investment opportunities aren't there. You mean that in the literal sense, because in the place of office and retail and lodging and all of those things, like those markets, unless you are just an aficionado of sort of Jumpman's daughter and you just enjoy picking through the discount bin to kind of find the best bargain you can get, and you want to celebrate that, you're going to be real challenged there. So there's this massive void, and so what's gonna fill that? What's gonna be the new pasture in which this capital grazes?
So I want to provide a little other context as a family office. Let's say too that legacy is important. So I want to continue what I have and protect my assets. I'm not in a harvest mode, and I am in a growth mode simultaneously. So again, the barbell strategy that we're looking at is important. So is it as simple to replace that office allocation with, because I've heard it called medical office buildings. I don't think we're talking about medical office buildings.
No, it's very different. Very different.
So what is the play there?
Yeah. I couldn't help but laugh, because when you describe it as that sort of, couple desire to grow, but to also facilitate, I guess, consistency and stability and things like that.
Yep.
Like, often the two are at odds. I can't help but think of my teenage son who, grown 6 inches and is like a baby giraffe right now. It's very difficult to do. And when you talk about the balance and the stability that you need, it's difficult to achieve. But I think that's what separates and makes healthcare real estate, right, in its 3 primary forms, the perfect substitute there. You're not going to find that stability in student housing. You're not going to find it in sort of self-storage, right? You may have at one point in time, but these recent challenges that the market's doing are sort of showing that there are cracks in the armor there.
Right.
So when you think about, and we discussed this at length, in our last conversation, the underlying fundamentals of the healthcare space, right? Essentially, its needs-based characteristics coupled with its resiliency with respect to the whims of market swings, that puts you both in an opportunity to get access to your core, opportunity to create value add components, right? Because it can be a combination of taking the existing, we're working on one of those now, where you can step into an existing footprint and create an enhancement, that value add component within the current built environment to facilitate a new need associated with growth.
So you bring up a really interesting point on the project that you've mentioned. And this is something I'm not sure investors really are aware of. We talked about this at some point, where if you drive down I-70 in Colorado and you pass Intermountain Hospital, you see the brand shiny new hospital. That's roughly a $700 million investment that was made by the healthcare system. We have a building on the campus that is connected through a sky bridge and also has connectivity to the parking structure in place. We're sitting on a ground lease, so I want to talk about that a little bit too. But so we have what I would consider a core investment that's generating a healthy yet stable return, and we have growth over time, right? But there's something that's different than a standard office building, which is you don't have, in our case, we have a healthcare sponsor that's made a significant capital investment in an acute care operation to take care of the market needs and all the fundamental drivers that we've talked about. And so as an investor, I start to feel pretty good about that.
You start to feel great about that.
Better than an office, I think.
Right. Exactly.
Probably better than a multifamily.
Yes, because you sit in the literal path of that amoebic growth.
Right.
And, at the risk of using too many cliches in the course of this conversation, it really is an all boats rise type thing, because, and that's why that sort of initial medical facility that's there was so critical and important.
That's so interesting.
In terms of what, we understand and believe that organic innate growth that the system is in. That's why they planted their flag there.
So many healthcare systems, when it's an on-campus, meaning there's a hospital there, there's an on-campus asset, there's a ground lease. And some investors may be familiar with ground leases, others may not. How do you think that functions into an investment decision? Does that create a concern? Does it create an opportunity? What's your take on that?
I think, it speaks back to our conversation around some of the key differentials between the healthcare space and in this context, particularly medical and others, because for other asset classes, so hospitality, for example, and it matters who the ground lessor is. Because one, you have concerns around term,
right? You
have concerns around use, and other sort of customary rights that a ground lessor would have that put the tenancy there in not necessarily a high risk position, but it sure ain't a no risk position.
Right. Yeah.
Whereas in the medical context that you're describing, the ground lessor is the system.
Right.
And it's even more important in an on-campus facility that that you're describing with the Intermountain example, because you have absolute assurance that the ground lessor will not necessarily cut its proverbial nose off to spite its face.
Exactly.
So I think in the context of your question, it gives the investor significant comfort that the ground lease is just a structural accommodation as opposed to a potential risk item that needs to be mitigated.
Well, there's a benefit to the investor too, because now we're talking about lower land basis, because in many cases those are treated as operating expenses. So now you look at your physical asset and your investment basis is typically lower than if you were to go out and develop an asset, invest in an asset on a fee-based piece of ground. And that happens. And
it does happen
viable option.
more often than not in an off-campus
right.
context, which you can it's sort of better understanding and things like that, and there are risk mitigants that you can pursue in that case. But you're absolutely right in terms of an overall cost basis perspective.
Right. That
makes the capital formation exercise in and around these medical deals much simpler.
So back to the construction idea. I'm going to keep going back to the barbell because it's just easy for me to think about. So I'm replacing, if I'm a family office CIO, I'm replacing some of my post-core type of investments with medical. Does the science look like medical as well as part of that construction of the portfolio?
Yes.
Okay.
And again, it goes back to the underlying fundamentals. Okay. So the fundamentals as between the science as we see it, right, and as we have articulated in the course of these conversations. So again, not your Alexandria, not your biomed, it's not your highly speculative. It's solid core tenancy.
Okay.
There may be some sort of ancillary bits, but you have what you need there. It's derivative of a healthcare thesis. It's often tied to academics. It's more. Right. It's very often on campus, so it has similar characteristics to the Intermountain example.
Yeah.
So yes, I would absolutely put it squarely within that.
Okay. And from a market perspective, am I as concerned, like, should I be targeting top 25 cities, the NFL cities, or do I have more opportunity as an investor because I can open up my geography as I start to think about diversifying my investments in this core element called medical and now science, I think, because a lot of this is credit build-to-suit driven.
And again, and I may sound like a broken record,
okay,
but that's quite all right. It's the music we want to play for this, because again, it speaks back to the fundamentals. And I think the secondary and tertiary markets are actually where you may want to focus for this particular exercise, because we discussed how in other asset types, how important that market is. Because if you find yourself in a secondary, tertiary market with, a hotel product that is anything other than, like low select service or roadside motel, you are going to be more susceptible to market fluctuations and those types of things. In the medical space and in the science space, in the context that we sort of work, the secondary and tertiary markets, those demand drivers are in many instances enhanced. So the need is greater.
So I agree with you. I do think from a developer hat on now too, and what we start to think about in those secondary and tertiary markets where the demand is high, the need is high, there may be multiple hospitals, healthcare players, providers in that particular market. I think being thoughtful about who you're hitching your wagon to really help them succeed in their business plan is really important, because in some of these markets, there will be a player. Sometimes there's multiple players that will succeed, but sometimes the market will only allow for, especially in the tertiary market, for one successful player.
Exactly. And to be clear, and as you know, we're not throwing darts.
Right.
And I think that's a big part of it. It's in no exercise that we would embark upon would it be kind of blindfolded or sort of willing. The diligence is there and diligence is done, but it's a very proper point.
Yeah.
Because just as the asset class has attributes of stability and continuity and consistency, so too do healthcare systems.
Right.
And not every healthcare system is built the same.
Yeah. Exactly.
And so you're right. You absolutely have to ensure that in making that choice and doing the analysis that the team you're joining
right
is the team that's gonna not be relegated.
Okay. So I think I have some clarity around when we start to think of the barbell and some of the core elements that we would put in there from a medical and science perspective. Well leased, growth in income over time, mission critical assets that have the strong demographic tailwinds behind it. I'm on board. Now I need to get some alpha.
Yeah.
Where am I finding that?
You're going to find it in medical, science, and seniors.
Okay.
And it sounds extremely self-serving, but let me explain the sort of relative relationship as between the three, because when you talk about ground up development, right? Because that's frankly where you get that alpha.
Yeah.
Because as we know, 85-90% of the value of any sort of vertical or of real estate is derived in the vertical process. Once the vertical improvement is in place and stabilized, that incremental value creation, understandably, is not as extreme or sort of lessens over time. So in the medical context, because of the very attributes that you just walked us through, the spread is understandably and appropriately narrowed. Because when you think about the risk exercise associated with that, it is significantly risk adjusted because of those characteristics.
Okay, makes sense.
And so I think that's a proper time to explain how the evolution of what's core, what's value, and what's opportunistic has evolved. Because I guess 10 years ago, 15 years ago, core was 4, 5, 6.
Yeah,
that classic coupon clipping.
Right.
Interest rates were, and the neutral rate of interest was negative.
Yes.
And at best zero.
Right.
So, core meant that sort of low single digit return profile. Value add could be anywhere from, 9 to 13.
Okay.
Right. And then opportunistic was sort of mid to high teens.
Right.
And then there was sort of extreme where you would, you're taking highly speculative risk and
sure.
where you go higher. As capital markets have evolved, as all of the things that we've, sort of discussed in the macro context have materialized, those definitions too are evolving. And so now you have to sort of view that through a different lens. Yeah. And so if you're looking at how do I get those opportunistic type returns, that's where you'll find it in the seniors.
Yeah. Okay. That's helpful. So now I've constructed a barbell strategy here. I have an idea of where I can deploy some capital and I can mitigate some risk, have some growth, protect capital. I think I understand the growth side of this. Back to my question. I'm a family office CIO, 10 to 20 million. I may not want to go all in on a particular asset. I may want to diversify, amongst that barbell strategy and that portfolio makeup we're talking about. Can we talk about a capital stack a little bit? Like how do you think about capital stack? Because I'm inferring that some of these projects have some scale to them.
Some of them do,
and some of them don't.
Right.
Not one size fits all by any means. But how do I deploy my capital so that I can spread that diversification across a broader base and have a little bit of the alpha and have a little bit of the just coupon clipper?
Yeah, and I love it. And that's that is the art of the science, if you will. When we talk about this a good bit, because to your point about scale, on the medical side, it can be challenging. Going back to your Intermountain example, that was a $680 million acute care hospital that the hospital sort of funded and built themselves.
Right.
Our ancillary medical outpatient facility was a tenth of the cost of that building. And that was a large medical development.
Correct.
It was 110,000 square feet.
Yeah.
the vast majority of these projects kind of skew in that anywhere from 30 to 60,000 foot range. Mm-hmm. So when you talk about the scalability from an equity deployment standpoint,
right,
you can be challenged to put significant amounts of capital to work. I'm going to use the term quickly.
Yeah.
Right? That said,
but I need to get yield. So.
Right. So when you ask, like, how do I think about cap stack?
Yeah.
We can get creative with where that equity sits within the cap stack.
Okay.
A way in which to, either give priority,
mm-hmm.
Or to ensure that there is, even in a common equity perspective,
okay.
A waterfall structure that ensures that we are meeting minimum levels of expectation that compensate that capital for the corresponding risk associated with the development. Because again,
okay.
it's a lower risk profile. So you got to get sort of creative. And in many instances, especially in the context of the private capital space,
right,
it's bespoke.
Yeah.
Like, what are you really looking for? Because then,
okay.
and then this is where more art comes into play. It's like, what are we doing in the other aspects, right? So when you talk about the returns associated with and attributable to the senior space, right? If you're generating the higher teens
mm-hmm.
Returns and the low 20s returns in that context,
mm-hmm.
and again, we're creating a portfolio,
right?
We're not just making individual dishes in
exactly.
isolation. We need to understand, okay, is this singles and doubles component of the medical portfolio creating that consistent, stable base upon which the higher risk profile associated with the seniors things can do what it needs to do,
right?
And so that in the end, when I'm saying analogies all over the place, but when the meal is served, it's exactly what you were looking for. It is seasoned to perfection.
Okay, so there's customization that goes into the capital stack.
Mm-hmm.
So I have an opportunity to, as an investor, to deploy capital amongst various segments of the healthcare asset class in general. How do you think, and how do we think about duration of investment?
Again, and it depends.
Okay.
But how do we think about duration? Because one of the interesting things that we're seeing a lot of now is, especially in the family office, private capital space, is less emphasis. I don't want to say it's de-emphasized so much as there's less emphasis placed on IRR, and it's more of a total return analysis. Okay. So now we're getting into an equity multiple conversation, which is influenced by the time value of money.
Sure.
But then you balance that with, well, I have a need for current income.
Right.
And I'd like to have some sort of current yield. I just don't want to sort of put my money necessarily in a lockbox and then come back in, 7, 8, 10 years and sort of collect and see what the capital elf left me. Right. So there's a balancing exercise there. So the way that we think about it is the medical space lends itself to a shorter cycle. That could be anywhere from 2 years to 4 years typically. Okay. And it really just depends, because development periods on typical medical assets, call it 16 to 20 months.
Yeah, makes sense.
Depending on size, location, market constraints, all that good stuff. On the senior side, you're looking at 20 to 28 month development period.
Okay.
Now we can talk about what we do in terms of during that development period, how do we enhance the predictability and the optimization of the leasing outcome, right? Because it's very different than how you would approach it in a multi-family context. Let's say you have a 24 to 26 month development period. It's, on seniors.
Yeah.
Then you have a 12 to 20 month stabilization period.
Okay.
Well, now you're squarely out between years 3 and 5 before you have a stabilized asset and things like that. So the life cycle there is, call it 5 to 7 years.
Okay.
So how do you reconcile the material difference between 3 years and 5 years and 7 years? And so you kind of have to, again, find that sort of happy equilibrium to balance the varying degree. It's like tax planning.
Sure.
Right.
Sure.
Everybody has different sensitivities and things around that in tax planning. So So bringing together a sort of solution that can, I'm going to use another food analogy, that can,
Are you hungry?
I mean, yeah, I'm always, is it a day that ends in Y? But, creating that sort of feast, if you will, that can accommodate food allergies, food sensitivities and all that, but then satiate everyone at the table. That's what we try to do.
Oh, I think that's well said. So with all this, you've helped me now as a CIO of a family office.
Do I need to be looking for a job?
No, I'm going to give you a check.
Yeah, I love you.
So what's the next move?
I think the next move is to reassess, right? We're taught at a young age, when you first enter the workplace and, you go and you have your first, training session on 401k investing, and that sort of thing. They talk about you're not a day trader, but at the same time, you need to have a rebalancing thing. I think now is an opportune time to rebalance and to look at the field and say, what used to be available to me is no longer available to me. So what is the highest and best use? Which asset classes do I need to fill that void?
That's great.
What's your move?
I think asset allocation, it depends on who the investor is and what their profile is. I think you can have your cake and eat it too. You can participate at either end of the barbell. I want to go back to the food analogy.
Yeah, I know. I was thinking.
I know you were. I participate at either end of the barbell, or you could go heavy on one side, depending on what your risk tolerance is. But it requires getting in the game.
Yeah. But no different than lifting barbells at a gym.
Exactly right.
You can skew towards the lower end, probably you can join me on the pie section.
Oh, I love that. Okay, that'll be my next goal.
I love it.
That's a wrap.
That's a wrap. Tortilla.
Thanks for listening to The Move, a show exploring what's shaping the future of healthcare real estate. If you liked what you heard, follow the show and share with someone you know looking to make their next move.